On May 6, 2003, a 26-year-old analyst in New York accidentally froze the entire United States Treasury market. In under 2 hours, $200 billion in Treasury trades went haywire, and nobody could explain why. Interest rates lurched in ways that simply do not happen in the safest market on earth. Phone lines at the Federal Reserve lit up, traders screamed across desks, and algorithms broke. The man who caused it was not a rogue genius or a criminal mastermind. He was a junior government employee who made one single clerical mistake before his morning coffee. But the strangest part is not the mistake itself. It is what the mistake exposed. The system protecting the most important financial market in the world had a catastrophic flaw nobody had fixed. Who actually knew about that flaw and why it had never been repaired is the real story here. To understand how one keystroke could bring America's debt market to its knees, go back to the 1990s. The United States Treasury market is the backbone of global finance. Every mortgage, loan, and bond price flows from it. Every single day, roughly $500 billion in United States government debt changes hands between banks, funds, and institutions. When you hear risk-free rate, the world means United States Treasuries, the gold standard of safe assets. By 2003, the system routing these trades was called the Government Securities Division of the Bank of New York. The Bank of New York was not just any bank, it was the single clearing agent for United States Treasury trades. If you bought or sold a Treasury bond anywhere on Earth, it almost certainly passed through one building in New York. This concentration was intentional. Centralized clearing meant speed, efficiency, and oversight. But concentration also meant one single point of failure for the entire global bond market. Sitting inside that system in 2003 was a young Treasury analyst at the Bureau of Public Debt in West Virginia. His job was routine: submit the results of Treasury auctions into the Federal Securities Processing System. Every week, the United States government auctioned billions in new debt, and his job was to enter those results accurately. He had done this dozens of times without incident. It was considered one of the safer government data entry roles. On May 6, 2003, he ran the morning auction entry process exactly as he had every time before. Except this time, one field in the software was left at its default value, 0. Before going further, understand exactly how Treasury auction clearing actually works, because this is where it gets dangerous. When the government auctions bonds, winning bidders must deliver cash and receive bonds within one business day. The Bank of New York sits in the middle, matching every seller with every buyer across thousands of institutions. If a bond does not settle on time, the bank lends the securities overnight so the system does not freeze. In a normal day, the Bank of New York might process $1 trillion in transactions through its systems. Every transaction had to be validated against a master record submitted by the Bureau of Public Debt. That master record told the bank exactly how many bonds existed, who was owed what, and for how much. On May 6th, that master record said the auction had issued $0 in bonds because the analyst left the field blank. The real auction had issued $24 billion in 5-year Treasury notes. Now the system thought none of them existed. Hundreds of institutions had bought those bonds at auction and expected delivery by end of day. But the Bank of New York could not deliver what, according to the system, did not exist. So it did what it was designed to do in a settlement failure. It kept lending securities overnight, over and over. By the end of that day, the Bank of New York had lent out $24 billion in bonds it did not have. To fund those loans, it had to borrow $24 billion in cash from the overnight money market. That was the largest single-day overnight borrowing by any institution in United States financial history at the time. But here is what made it catastrophic. The Federal Reserve had set the overnight rate at just 1.25%. When the Bank of New York suddenly demanded $24 billion overnight, the available supply of cash evaporated instantly. The overnight lending rate spiked from 1.25% to nearly 0. Lenders were so desperate they accepted almost nothing. That rate spike ripped through every short-term money market fund, every repo desk, and every bond trader on Earth. Traders stared at their screens, watching rates do something they had never seen and had no model for. Risk systems at hedge funds and banks began automatically triggering margin calls and stop-loss orders across positions. And still, nobody knew what had caused it, because the error was buried inside a government database in West Virginia. The Federal Reserve's open market desk in New York began receiving frantic calls from primary dealers within the hour. Primary dealers, the 22 banks licensed to trade directly with the Fed, are the pillars holding the market up. When they started calling the Fed in panic, regulators knew this was not a normal market fluctuation. The Fed's investigators began tracing the disruption backward through the clearing system, counterparty by counterparty. Every trail led back to the same institution, the Bank of New York, and its $24 billion overnight position. And then investigators traced it one step further, back to a single data file submitted from Parkersburg, West Virginia. Remember the flaw that nobody had fixed? The question that started this whole story. The software the analyst used had no validation check. It accepted a 0 and processed it without a single warning. No pop-up alert, no supervisor confirmation, no automated cross-check against the actual auction record from the same day. The system simply trusted whatever number was entered and fired it downstream to the most systemically important bank in America. Internal government audits had flagged the lack of input validation as a risk as early as 1999. 4 years passed. The fix was budgeted, deprioritized, and ultimately never implemented before May 6, 2003. That is the real answer. Not one careless analyst, but 4 years of institutional negligence made visible in a morning. If this story makes you rethink what safe really means in finance, like this video and subscribe to Wealth Signal News. The Federal Reserve made an emergency decision within hours. It would extend the Bank of New York a $1.5 billion credit line, not $24 billion, because the Fed also quietly pressured major banks to lend the rest at near zero rates. By 6 p.m. on May 6th, the Bank of New York had patched together emergency funding from 8 different sources. The overnight rate normalized, the market exhaled, and most news wires never ran the full story. The Treasury Department issued a quiet 1-paragraph statement acknowledging a processing error without naming the system or the person. The 26-year-old analyst was not fired, not prosecuted, and not named publicly. Because legally he had done nothing wrong. He had followed every procedure he had been given, none of which required him to double-check for a $0 entry. The software patch that had been delayed for 4 years was finally approved and deployed within 90 days of the incident. 90 days after 4 years of inaction, because now everyone had seen what a single missing validation check could cost. But the real lesson from May 6, 2003 goes far beyond one bad database field in West Virginia. The United States Treasury market is still, in 2024, dangerously concentrated. The clearing system has become only more centralized since 2003. The Securities and Exchange Commission spent the next 2 decades debating mandatory Treasury clearing reform. In December 2023, 20 years after the incident, the SEC finally mandated central clearing for United States Treasury trades. 20 years to fix the structural vulnerability that a 26-year-old exposed in a single morning. In between, the Treasury market nearly froze again in March 2020 when COVID triggered a liquidity panic of historic scale. In September 2019, the repo market and the same overnight lending market the 2003 era disrupted seized up without warning. The pattern is always the same: concentration, complacency, then a single trigger that nobody thought would matter. The Treasury market is where your pension fund parks money, where banks hold capital, where the dollar itself gets its price. When it hiccups, your mortgage rate moves, your savings rate moves, and every stock price on earth recalibrates. In 2003, the hiccup lasted less than 8 hours, and almost nobody outside a few trading floors ever knew it happened. That invisibility is the most frightening part. Systemic risk that the public cannot see is risk that never gets fixed. Now go back to May 6, 2003, and the question this story started with: who was really responsible? Not the analyst. He was following rules that a broken system handed him without a single safeguard. The audit reports from 1999 show the flaw was known, documented, and funded for repair, then buried under budget cycles. The real culprit was the institutional assumption that because the Treasury market had never broken, it never could. Every financial crisis in history carries the same fingerprint. The thing everyone called safe right up until it wasn't. A 26-year-old in West Virginia did not break the Treasury market. He just revealed it was already broken. And that is the line that should follow every investor, regulator, and government official into every meeting they ever take.